Section 263A of the U.S. Tax Code plays a crucial role in how businesses account for certain costs related to inventory and production. Understanding these rules is essential for accurate tax reporting and avoiding potential penalties. Section 263A contains the Uniform Capitalization, or UNICAP rules. These rules dictate how certain costs should be capitalized or expensed over the long term, rather than immediately expensed in the current tax period. The primary goal is to ensure that businesses accurately allocate expenses related to the production or acquisition of inventory. The rules primarily apply to two groups: producers and resellers. Producers are those who build, manufacture, construct, or improve property. Resellers are those who purchase inventory to resell it to another party. However, there are some important exclusions. Small resellers with average gross receipts under $10 million in the last 3 years are exempt for personal property. Producers may be exempt if their production costs are less than 5% of the price charged to customers, or if their total indirect costs do not exceed $200,000. Under Section 263A, businesses must capitalize several types of costs. These include direct costs such as labor and materials that become integral to the property, indirect costs that benefit the production activity, and certain service costs related to administration and general expenses. For producers, this can also include pre- and post-production costs like real estate taxes and zoning costs. Calculating Section 263A costs involves several steps. First, determine all indirect purchase costs such as processing fees and warehouse expenses. Next, allocate these costs between the cost of goods sold and inventory. Then, classify the allocated costs as administrative, production, or mixed services. Finally, determine the adjustment to be added to the ending inventory for tax purposes. Let's look at some examples. For a producer, direct costs might include wages for workers assembling products and the cost of raw materials. Indirect costs could include depreciation on factory equipment and utilities for the production site. For a reseller, direct costs would typically be the purchase price of inventory items, while indirect costs might include warehousing fees and quality control expenses. The IRS does allow for simplified methods to calculate 263A costs. These include the simplified production method and the simplified reseller method, which use specific formulas to allocate additional costs to ending inventory. These methods can reduce the administrative burden while still ensuring accurate cost allocation. Accurate application of Section 263A rules is crucial for businesses. Failure to properly capitalize costs can result in significant penalties or adjustments during IRS audits. Given the complexity of these calculations, many businesses find it beneficial to seek assistance from professional tax preparers to ensure compliance with all IRS regulations. In conclusion, while Section 263A can be complex, understanding its basic principles is essential for businesses involved in production or resale. By properly categorizing and capitalizing expenses, companies can ensure they're in compliance with UNICAP regulations and accurately reporting their inventory costs for tax purposes.